Hello, my name is Andre, and I'm a founder of Opium Team, Opium Protocol, and several projects which I built on Opium Protocol. So my past experience, I was a trader, I was a fund manager, and I was a mathematician even before. So I was basically trading derivatives for more than 10 years, and I would like to tell a little bit about DeFi, about derivatives which are old school, so centralized derivatives. You can call them old finance or real finance or whatever you call it. It's the biggest market in the world, and it's functioning really well. Allows you to do a lot of interesting stuff. It allows you to hedge. Allows you to run your business normally, and it allows you to do speculation and all kind of strategies. So I recently wrote an article about those type of strategies, which got a lot of positive feedback and interest to hedge fund uh, to these type of strategies to this type of funds is growing in DeFi. I got a lot of questions, so I decided to share it with you with this course. And I will be just covering some basics. So you need to read much more. You need to understand how that works, and if you're really interested, that it's a lot of time, a lot of mathematics behind it. But I will just cover the basics, and I think you will have a good understanding of what it is. And if you decide, you can always go deeper. So, starting, what is the hedge fund? So, why it's called hedge? Historically, it was the funds who were taking short and long positions in equity at the same time, and that's the where the name is coming from. Nowadays, is the biggest fund, and you heard about them, and you heard about them because they are so cool, and because people making so much money and people getting rich. So this is one aspect. Another aspect, that a lot of them, they are bankrupt, and they were dying because they took too much risk. So basically, those are funds which are not accessible to general public, but which allowed to have all kind of aggressive strategies with a lot of risks and very less regulation. So that's funny. Just a funny thing that everybody wants to be a bank nowadays. And I always say that it's funny that the crypto community, and I was in crypto community like 6 7 years ago already. That was the people who did not like bankers. They did not like ideas of the bank. But now in DeFi, you see the same people. They just looking for passive income, and they behaving like a real banker. That's really funny. So I will cover some topics. I also will speak about interest rate swaps, but a little bit about myself. I'm founder of Opium Team, and that's again the team who built all kind of decentralized derivatives. I'm a founder of the Art Exchange, and this is derivatives for the art market. So we do it first time for the art, together with a partner, the team from the Art newspaper. That's the biggest probably newspaper in the world, and very respectful newspaper. So we do this project to change the art market, because that looks a little bit inefficient to me. When I knew how art is traded, that was really that's really amazed me. So yes, I was investing in some small startups for 5 years, and I was managing a very big fund, billions of euro, mostly derivatives and all kind of fixed income. And before, I was a mathematician at Moscow State University. That's one of the best place for mathematics in the world. And at some point, I decided to switch my career from mathematics, from theory of probability, to something applicable, and that was risk management and financial markets. Then I became an analyst, and I was a trader, fund manager, senior fund manager. So I did some career, which was interesting, but now we're building the future, I believe. So let me explain what hedge funds are doing in very simple example here on this page. I already said that they are not available to the main public, not directly. They extremely diversified the strategies because they can do anything. They specialize in one thing, and the key thing that on the markets you don't need to be right 100% of the time or know everything. You just need to know 3% of of what's going on, and if you know it much better than others, then you can be very successful and very rich, and you can run the hedge fund. So yes, again, almost any strategy, but also almost any risk, and regulation differs. It differs per country, but in US and some main jurisdictions, it's quite light. So again, what hedge funds are doing? They trying to take the risk for the good price. That's pretty good definition, pretty safe definition. And how you can do it? For example, if I buy some instrument of financial portfolio which consists of several risks, so risk 1, risk 2, risk 3, risk 4, but I don't like really risk 2, 3, and 4. I think risk 1, that's what I need, and the problem that I cannot take it isolated. Well, with derivatives I can. So I just find derivatives which represent R2, R3, and R4, and I'm gonna short those derivatives. Maybe it's gonna be one derivative, depends. So, but at the end, I will end up with risk 1 and some price which I pay for it, and some return which I expect from it. So if I'm right, I can enjoy the return, and I don't run any other risks that the risks I want to run. So the most simple example is alpha trading, equities. I buy, for example, Tesla because I think Tesla gonna do good, and this is not my opinion, by the way, but just an example. But I don't like to take risk of the equity market because I think Tesla should do better than everything else. But equity market, I have no idea what's going to be there. So I just buy Tesla future and I sell future for the corresponding market, for the whole market. And by doing this, I'm basically only running the risk of Tesla. So buying Tesla, I bought two risks. Risk 1 is risk of Tesla, and risk 2 is a risk of equity. By selling the future for equity market, I'm getting getting rid of the second risk, and I'm only enjoying performance of Tesla. If Tesla does better than market, my long position is doing better than my short position, so I'm making money. And if Tesla does worse than the market, another way around, so I'm losing money. So that's a very simple example. Probably you know about it, but just structuring it in a proper way. What does the light regulation mean? Now we go to regulation. Okay, now we know about risks. Now we go to regulation. It means that you can be a shark, and you can act where big players or other investors cannot act, and you just take inefficiencies and make money out of it. You get rid of inefficiencies and you make money. So that's pretty cool. But you also can take a lot of risk, a lot of risk which is distributed in the way that you can make money unless you lose everything. And that's also happening, and it's very difficult to distinguish. You can also do certain things which large institutional investors, big players, whales cannot do, and make money out of it as well. So, for example, what I'm talking about, let me make an example. I was working managing the fund, and we had a lot of bonds from France at that point. And France used to be AAA by all agencies at some point, and then it started to lose the rating. I think it was it S&P or Moody's who I'm not sure. It was so long ago. They downgraded France to AA, AA plus. I don't remember again, but the point that we needed to sell all the France because our mandate only allowed AAA by all agencies, and so did Arabic investors. They had 30 days to get rid of French bonds because they cannot hold it according to mandate, and mandate something you agreed up already with your clients and so on, and to change the main mandate is quite a long process. So hedge funds basically knowing that those funds gonna sell, but not because France is French debt is bad debt. No, French investor, they just hold all the debt, so it's hold internally. It's pretty big economy, it's good economy, and so on and so on. And their hedge funds were acting and making money. So, but most sexy hedge funds, what they do, they just take inefficiencies out of the market. And in terms of risks, is nice risks which are nicely priced. So not a big risk which is priced nicely and I can expect some return. Well, very simple to understand. Philosophy of it. If we play the game, number one, I drop a coin and I get paid either $2 or I pay $1, depending on the outcome. And that's the game, which is risky because I can lose, especially if I play once only. But on average, I'm gonna make around $1 for every time I'm playing, and on average, I'm gonna make money. The more I'm playing, the more money I do. The risk is pretty clear. If I lose a couple of days in a row, then I'm gonna win. According to third probability, if the coin is equal, it's fine. So, but that's a nice game, and that's a nicely priced risk. Everybody would like to play this game. What happens if we're gonna add another condition, number 2? So once a month, randomly, I take $20 from you. So you're playing the game, but the master of the game comes randomly a certain day of the month and says, "Okay, now pay me 20." Well, you probably gonna play this game anyway because you're gonna make $30 by playing the game, and you're gonna lose $20 because the master comes of the game and he takes it from you. That's still a nice risk, but the risk has a tail risk. So that the event which happening very rarely, but it has some negative consequences. So if we add condition number 3, so that once a year the same person comes to you and take €1,000 dollars. Sorry, I live in the euro area. So then the game is not attractive anymore because you expect to win $360 per year, but if you play long enough, you're gonna lose, of course, all the money and even more. So still, a lot of people would like to play this game for a week, and on average, they may make $7, but the tail risk is huge. And my point here is that what is the difference between the good trade and a bad trade? If you're a hedge fund, you're doing something, and one hedge fund is making money, another hedge fund is making even more money. So the difference is not the amount of money they make, but the amount of risk they take and the distribution of the risk. Because risk can be very plain and directly distributed across the time or any other way, but it can also be intransparent and hidden. You may run 5 risks which are very small, but they may be correlated to some tail risk, and maybe they can be realized at the same time. So the difference between the good trader, hedger, and a bad one is the risk. It's not a return. It's very important. So, okay, derivatives. Coming back to derivatives, as I said, they super efficient. It's pretty fast, cheap, and very diverse. So I can find any derivative almost for anything I like. There are even derivatives for future movie sales in Hollywood and so on, so on. So it's a big market. Somebody may say it's like making bets, but it's financial bets. So how big is the market? Actually, not to say it's big, it's big, it's big. I made a chart where you see size of the stock market, bonds, gold, crypto. We made even bigger than it is, but still. And the global GDP. So global GDP is somewhere between stocks and bonds, but derivative market is I think 15 times higher. And big part of this market is interest rate swaps, all kind of interest rate swaps, and that's why I'm gonna speak about them separately as well. So we coming back to hedge funds. So the entry barriers to run one were very high, and now with DeFi, everyone can do their strategies, because I think that DeFi is biggest sandbox. Still, it's a sandbox, but it's going the right way. And before it's gonna go to the real financial system, it should prove itself in a sandbox. So, but it's big enough already with $1 billion US dollars. It's already big enough to act as a hedge fund, to do some trades, and we've seen a lot of people just made money and were successful traders, arbitrageurs, even flash loans. It's pretty cool concept which shows how you can make money by eliminating inefficiencies in the system. So everybody can take a trade as sophisticated as they can afford. They can understand. No barriers, no regulation yet, no KYC. It's pretty cool. And I just said here that when I was studying, I dreamed that I'm working in a hedge fund, that I was managing interest rates hedge fund, and now I can own my own fund and even several thanks to DeFi, and it's only going to get better and better. So that's a couple of charts about the size of the global financial assets, just to give impression how big the markets are. So the top gray is the stock market, and it's pretty small comparing to everything else, which is fixed income markets, so-called fixed income markets. It's bonds, it's all kind of instruments with fixed cash flows. And on the right side, it's measured in percentages of global GDP. So you can see that even stock market is already like almost like a global GDP. Okay, this is just to give impression. And why I said about it, because I want to emphasize that fixed income market is quite big market by itself. And in fixed income, it's a lot of mathematics. Simply speaking, it's almost only mathematics, because of all kind of assets and liabilities with fixed cash flows, fixed interests, and so on and so on. There are a lot of relations, equations, which are hold. Some of them hold all the time strictly. Some of them hold most of the time statistically, so they can deviate, but not for long. And that gives us opportunities to do arbitrage and statistical arbitrage. So that two type of investment strategies hedge funds can run. Arbitrage is basically making money without risk. So if I can sell and buy something for different price at the same time without any other risk of delivery and so on, that's arbitrage. Statistical arbitrage is more like 99% of the time interest rates are correlated, and I can change one with another that gives me extra return, and I hope that it's going to be fine, or statistically it's going to be fine. That's both pretty common strategies. So statistical arbitrage is just difficult to understand. You need to understand statistics, because a lot of people, they don't understand statistics really well, and I've seen so many times they fail just because they don't understand statistics. So you need to master like basic statistical knowledge. You need to understand how hypothesis works, how general relationship work in statistics. And my favorite joke here is when I actually read once, I was managing a fund. I read a report, and it said something ridiculous. So I called the guys, and I started asking them questions who made this report from big investment bank, and they were not able to answer. And then I need to explain that report is rubbish to my colleagues. I did very shortly with this joke that I said the quality of report is the following: 5% of car accidents is done by the drunk drivers. So they making conclusion that 95% of the car accidents are done with the sober drivers, and then they making conclusions that it's much more dangerous to be sober, because 19 times more you got into a car accident. And that's a joke, but I've seen this a lot, and even big money were invested with assumptions like this, because when it goes to statistical arbitrage, it's quite complex and sophisticated logic. So you need to make sure you understand, or your analysts understand what they're doing and what is the tail risk again. So then some cool strategies, or most probably of the strategies, by number of strategies, you can do analyzing different factors of the market, and that's fundamental analysis. What is like fundamentally fundamentally swap curve is working in a certain way, and if it's broken, that's fundamentally wrong, and you can make money out of it, and that's fundamental analysis. But if you do only one type of analysis, you can limit yourself, because there is macro economy, macro world, that is driving everything else. And if you forget about it, maybe there is a reason. Maybe that's because Fed is planning to lower the rates, and maybe your analysis is doesn't take this into account. So then you also need to look technically. Technical analysis, on my opinion, not very strong, but it works as long as people believe in it. So, and you can see this by different thresholds, which are difficult to break. and sometimes it's psychologically. So people like to buy gold for, I don't know, 99, but they don't like to buy it for 101 because it's much different for human being. And they also put contracts, strike prices, and so on route numbers, and that also the reality. So technical analysis makes sense, but you need to understand why it works. Then sentimental factors can be anything, like certain presidents say something in Twitter, and that can ruin the market. So, or people willing to do something in the country, and there's a public opinion against something. That's very important. You don't want to underestimate it. And you can also do passive investment when you just choose the market, or you choose an asset and you just invest passively. Not a bad strategy, but you need to think of asset allocation. Actually, it's more return, more money are done with asset allocation than with just stock selection or just trying to pick up something good from the market. So passive investment is a big thing, and especially if you diversifying your portfolio across different asset classes. So coming to interesting part in DeFi, yield hacking. So yield hacking, I'm saying that yield hacking is basically hedge funds. The same type of strategies, the same type of ideas, and all the yield hackers are hedge funds, but in DeFi. So what do you need to remember? If you do yield hacking, you need to basically remember everything what you do when you think of the hedge fund. So risk return, super important, and distribution of risks, just everything. So, and I want to make a point that the tail risk called Black Swan by Nassim Taleb, it's event which is probably not going to happen, but if it happens, everybody will have catastrophic consequences. So that's called Black Swan or tail risk or whatever you want to call it, but it's pretty common in financial systems, and DeFi or open finance is just waiting for it. The reason is very simple. That's because of greed, and greed is one of the underlying drivers for everything in the world. So it's too easy to hide the risk in DeFi, and I think it's going to happen. And a lot of people will take a risk that they don't understand, because it's too easy to repack the risk, to hide the risk. Bankers were doing it for all history with any kind of regulation, so they just go around. Then you have another regulation, then they go around. So that's going to happen in open finance as well, because it's non-regulated, and it's just an ideal to make a transparent products risks, to sell it to public with no liabilities, nothing. So that's it about hedge funds, and this is the general overview. So you would need to read a lot, and you would need to understand all kind of strategies and so on, so on. But what I want to emphasize that risks is the key, and tail risks, it's something you need to understand. If you don't understand the risk, better don't do it. So, and regulation is good. Regulation is not so bad, but it shouldn't be extreme regulation. So when I was working in a fund, it was like 200 regulators and all kind of compliance procedures for us, and that's obviously too much. But having zero regulation, like everybody can do anything, it's also not. It's another extreme. It's also not so good. So, thank you.